Hello, this slide show we're going to talk about accrual accounting, and we will be talking about balance sheets and income statements. So when we talk about accrual accounting, it means that we are going to count things when they happen rather than when they are paid for or whether we receive income for them. So when a patient receives services, we're entitled to income. So we're going to measure it at that point, at that day that that patient is coming into the hospital, let's say. We are not going to count that patient income when we receive it, which might be a few months later, given some of our third-party payers, but we're going to actually count it the day that they stay in the hospital. When we use resources to care for the patients, we measure the cost at the time that we are receiving and using those resources. So we don't count them when we pay for them, but we count them as we use them. So accrual accounting underscores the timing of activity, and really cash flow is irrelevant. It doesn't matter when we receive the money or when we spend it. So a patient submitted on September 8th, 2014 and was discharged on the next day. The hospital was paid by the insurance company on October 31st of 2014. Should the income be recorded on the September or the October income statement? Well, if you said the September income statement, you are correct. So that is when the revenue would be recorded. Let's give another example. Employees are paid every 2 weeks. This Friday, they'll be paid for the pay period ending September 6th, 2014. And that pay period covers a two-week period. What month's income statement should record the expense? Well, this one's a little trickier because part of that expense should be recorded in August, the first part of the pay period, and the last 6 days of the pay period, it should be recorded in September. The accountants have to do some math there. Actually into September, when they're recording August income statements, to take into account the accrued pay that was earned by the employees the last days of August, and they have to subtract out the amount from that payroll that was actually earned in September. And then sometime in October, they have to balance it back out. And so when they're doing the September statement, they will just count the first 6 days of September, the last 6 days of that pay period for September. So it's actually divided up. So what month's income statement should record the expense? Well, it's both August and September. So I'm sure this is just a review of what you've already heard about accrual accounting in your accounting class, but I just wanted to go over that to make sure that you understood or just reminded of that's the kind of accounting that we use and will be using in class. So let's talk about a statement of operations, or the income statement. The statement of operations records all revenues, like gross patient services revenues. It records also any deductions from revenues. And of course, then there's the net operating revenues, the gross patient minus the deductions from revenues. Because of accounting principles and just the way that accountants have recorded these things in the past, we have developed a pattern of recording these income and deductions from revenues in a particular manner. All gross patient services revenues are listed as obviously a positive number. The deductions from revenues are listed in revenues but as a negative number. So when we then want to determine the net operating revenues, we add the gross patient services revenues to the negative number, the deductions from revenues, to come up with that net operating revenue. Then, if there are other operating revenues, those are listed. We then have operating expenses. They can be listed by the organizational division, for instance, departments. They could be listed for the nursing department, administration, PT and OT, the dining, plant management. So the different organizations of the facility, um, we divide up all of the operating expenses by and put them in those particular organizational divisions. They could also be listed by the object of expenditure. In other words, we'd list all payroll in one place. We would list all supplies in another place. That's not very helpful when it comes to a department head, but it is very helpful for, let's say, if the operating statement is for the people that are on the board members who want to see a big picture idea of how money is being expended. But most statement of operations are organizational division, are divided up by organizational division, because that is the most helpful to the department heads who have to run those departments. We also have, in addition to other expenses, we have our depreciation expense. The depreciation expense are that month's amount of the depreciation for that year. So let's say the building has an annual depreciation of $20,000. Well, they take the $20,000 and divide it by 12, and that's the amount for that particular month. And the amount of depreciation is determined by accountants, again, buildings and things. Typically, they're depreciated out over 40 years. If it is a piece of equipment, depending on the equipment, it could be anywhere from 3 years to 10 years. And we just take the expense of that particular, the cost of that particular item, and divide it by the number of years of life that is given to it, and that's how we determine the depreciation for that particular item. We then add up all the depreciation, again, divide by 12, and that's the monthly depreciation, and that's recorded then in the statement of operations. The interest expense is exactly what it states. Any interest owed on anything is listed. Bad debt is an expense listed. Anything that, any accounts that have been in accounts receivable, we've tried to collect on them but can't, and we've just kind of given up. We write them off as bad debt, and that's listed as an expense on our statement of operations. Now, that's different than charity care, which is listed actually in the revenue side. It is listed as a deduction from revenue. So that's a lost revenue that we know ahead of time we're not going to receive. But any revenue that we expect to get, that we actually bill for, and we don't get, that's considered bad debt. We also have non-operating income and expense, things like vending machine income and vending machine expense, those kinds of things. And we have net income or excess of revenues over expenses. So this is basically just taking our revenue minus our total expenses, and we list that as net income. And that is what goes on a statement of operations. The statement of operation updates the balance sheet. The balance sheet is a snapshot in time, typically at year end, as to the health of the organization, and lists all the assets and liabilities. We'll get into that in a little bit. But at the end of a fiscal year, the statement of operations zeroes out, and the net earnings or loss is transferred from the statement of operations over into the unrestricted net assets on the balance sheet. And so the balance sheet is then updated from the statement of operations. So theoretically, on within the first few seconds of a new year, fiscal year, after midnight, all of the numbers on the statement of operations are zeros. And then we start accumulating expenses and revenue, and it shows up then at the on our first month statement of operations. The statement of operations are typically shown both for the active month, as well as year to date. So let's say that the fiscal year starts in January. Our January financial statement of operations would include all the expenses and revenue for January. Our year to date would have exactly the same numbers because it is January's the only month we have experienced so far. And then February, we would have all of the totals from January plus February as our year to date, and so on. Okay, so that's the statement of operations. Let's move on to the balance sheet. Balance sheet is a snapshot showing our assets, liabilities, and equity. Now, equity is named a number of different things. It's called owner's equity, net assets, fund balance, or any other words that indicate net worth. Now, a balance sheet always balances to the equation assets equal liabilities plus equity. And therefore, of course, assets minus liabilities equal equity. So the balance sheet has to balance. It's just that's the way that it's put together. If we look at all of our assets and we subtract our liabilities, we then end up with our equity. And the liabilities and equity show up on the right-hand side of the balance sheet, and those assets are on the left-hand side. Let's say that you've got a house worth $200,000. And you have $100,000 due on the mortgage. So on the left-hand side, the asset, which is the house, we would have it listed as $200,000. On the right-hand side, we would have liabilities of $100,000 and net worth of $100,000. So we've got again on the left-hand side, the assets are total $200,000. And on the right-hand side, our liabilities plus equity equals $200,000. Our assets are economic resources that provide benefit to the organization. We list current assets as things like cash, temporary investments, net receivables, inventory, anything that can be turned into cash within a year. And typically we list the most current assets first, and then the less liquid or less current assets go down the list. Non-current assets are economic resources expected to be held for more than 1 year. And sometimes we call them fixed assets, things like buildings, major equipment, things like that. We have a number of contra accounts that we need to list. Typically, they're listed only on the asset side. A contra account reduces the book value of an asset by some determined amount. So we have two contra accounts that we're going to be dealing with. One's accounts receivable. So we have the gross accounts receivable that is listed. And then we have the amount of accounts receivable that we think we're not going to be able to collect. Call that doubtful accounts. And so we have that amount. It's shown up on the asset side, but it shows up as a negative number. So accounts receivable has a contra account listed as a negative number and reduces the amount of receivables by the amount that the organization thinks it will not be able to collect. non-current assets that depreciate. So those fixed assets we talked about, those kinds that depreciate, and all of them do, um, they will have a contra account that lists the accumulated depreciation as a negative number. So that also is deducted from the non-current assets or the fixed assets. It is listed as an asset, but it's listed as a negative number. Then on the right side of the balance sheet, we have liabilities. Liabilities are economic obligations. Current liabilities are all the obligations due in less than a year. Things like accounts payable, accrued expenses, like payroll that we talked about before. Deferred revenues, money possessed but not earned. Current portion of long-term debt. Going back up to payroll. As our employees work, they're earning their revenue. They're earning their paycheck. But we don't pay them every day that they work. We only pay them on maybe a bi-weekly or every 2 weeks basis on payday. Well, from the time that they actually earn that money to the point when we pay them, it is listed as a liability. It's an accrued expense. Okay, non-current or long-term liabilities. They're the balance of long-term debt minus the amount paid in the current fiscal year. So it would be if we had a mortgage on a home of $100,000, well, we're going to pay $10,000 of it this year. $10,000 would be considered the current portion of long-term debt, and the $90,000 is this non-current or long-term liability. Equity is the difference between assets and liabilities. Net assets or fund balance typically are the words used for not-for-profit organizations. Shareholders' equity or owner's equity is typically used for for-profit organizations. It's just the difference between the assets and liabilities. Some of those net assets can be unrestricted. The owner or operator can use them for whatever it needs to be, they need to be used for. Restricted net assets are things like maybe a donation that's donated for a particular period of time or particular project. Let's say that there's a children's hospital that they're going to build a new wing, and they receive a donation of $10 million. That would be put into the restricted net assets that is permanently restricted to only to be used for the addition to the hospital. Some things can be temporarily restricted. Sometimes people will donate some money to an organization and have that organization pay them interest on that money until that person dies, and then the money becomes the organization's, and at that point they become unrestricted. So they're just temporarily restricted just for that period of time.